You are welcome. This is ACC 311 Financial Accounting for 300 level students of Accounting, University of Lagos. This is video 2. My name is Dr. Mayo Redele. In video 1, we discussed financial instruments as a way of introduction, and this is video 2, financial instruments, focusing on presentation of financial instruments. And I want to say once again that we are going using this approach because the university is going online because of the current COVID-19 pandemic. So this this lecture is prepared actually for our students in 300 level accounting, offering ACC 311. So as a way of introduction, in the last video, I explained that financial instruments gives rise to or results in financial assets for one entity and financial liability or equity instrument for another entity. And we explained that what are the conditions that must be met before you say a transaction is a financial liability or it's an equity. That's what we'll be discussing mainly in this video 2. And it is actually covered by IAS 32, and the objective is to establish principles for presenting financial instruments as liabilities or as equity, and also for offsetting financial assets and liabilities. So the main thrust of this standard and the emphasis here is that financial instruments should be presented according to their substance and not merely their legal form. Let me be quick to say that, for instance, there is a particular transaction and this is the legal description. For instance, you have your share. By legal classification, or in terms of legal form, share is an equity. But that share, depending on the circumstances, depending on the scenario surrounding it, depending on certain conditions, that shares can be classified as a liability. That means the substance of that share is taking precedence over the legal form, even though it is a share, an equity in terms of legal form, but in terms of substance, it can be a liability. So, the main emphasis of this standard, therefore, is that financial instruments should be presented according to their substance and not merely according to their legal form. In particular, entities should use financial instruments, or entities which use financial instruments should classify them or their components as either financial liabilities or as equity. And what determines that is the substance of the contractual arrangement and then the definition of a financial liability and equity instrument. So don't forget, a financial instrument, on one hand, financial assets, on the other hand, financial liabilities or equity. So then the question is this: that's financial liability or equity, that's our focus. So when do you classify a financial asset as equity, or as equity instrument, or as liability? So it is classified as liabilities when there is a contractual obligation to transfer economic resources. Listen very well. When you have obligation to transfer resources, the resources could be cash, could be what do you call it, equity of another entity. So once there is a contractual agreement to transfer resources, then you refer to that as liability. But on the other hand, if there is no contractual agreement to transfer resources, in as much as money is not leaving you, cash is not leaving you, or equity share of another entity is not leaving you, then you refer to that, or you regard that as simply equity, as equity. Now, the ability of the usurer to satisfy an obligation may be restricted, even though you are saying that for a transaction to be classified as liability, it means that there is a contractual obligation to transfer economic resources. That notwithstanding, it is not going to be hindered by the ability of the issuer to satisfy that obligation at that present time. For instance, there may be restrictions in terms of how to access foreign currency, and so the person is not liquid, so you cannot actually make that settlement at that present time. That notwithstanding does not stop it from being regarded as a what? As a liability. So it is absolutely irrelevant. So any other instrument that does not meet that criteria is simply referred to as equity instrument. I want to come again. You classify a financial instrument as a liability once there is a contractual obligation to transfer economic resources, regardless of the way the contractual obligation will be settled. That's not a problem. And the issuer's ability to satisfy an obligation may be restricted due to lack of funds or anything. Even though the issuer cannot meet that obligation at that present time, that does not in any way stop the fact that it is still referred to as liability. So, but this is irrelevant as it does not remove the issuer's obligation or the holder's rights under any instrument. So any other instrument that does not meet that criteria is simply referred to as equity instrument. So therefore, we can say that a financial instrument, like we defined in the last class, is a liability if there is a contractual obligation on the issuer either to deliver cash or another financial asset to the holder, or to exchange another financial instrument with their holder under potentially unfavorable conditions to the issuer. So it therefore means that financial instrument will be classified as equity if there is no contractual obligation to deliver cash or other financial assets. So what differentiates equity from liability is that for equity, you have an obligation to transfer, obligation to make payment and all that, or transfer economic resources. While for equity, you don't have obligation. So you are not paying back that thing that you have collected. It has added to your capital, and all that. So you are not paying it back. You are going to retain it with you. So that is just the difference between them. And it's very, very important also that we should emphasize that, let's give a classic example of ordinary share, for instance. Ordinary share is a perfect example of equity instrument because, the issuer, the issuer has no obligation whatsoever, has no obligation to pay dividend or to repay the share capital or to deliver cash or any other financial assets to the shareholder. For instance, ordinary shares, you understand very well that when there is no profit, they won't declare dividend, and the shareholders, except their preference shareholders anyway, the shareholders do not have claim on subsequent year profit to say, we didn't collect dividend last year, we want to collect our dividend now. They are not entitled to it. So you can imagine they are not obliged to pay dividend, and they are not also going to return to pay back the capital to them. So that means there is no obligation. There is no obligation to pay. So you simply refer to that as what? As equity instruments. But that is not the same case, or that's not the case when you have loan. Because as far as loan is concerned, both the interest and the loan will be what? Will be repaid. So you refer to that simply as what? Financial liability. You refer to that as financial liability. So it is very, very important that we should have that understanding. It is very, very important. So although substance and legal form are consistent, meaning that when you say, a transaction should, the substance of that transaction and the legal form, most times they go together. When a transaction, the substance of that transaction goes in line with the legal form. But there are instances when that may not necessarily be consistent, when that may not necessarily have to hold. And, for instance, for a financial instrument, that I think I mentioned that earlier on. For a financial instrument such as preference share, particularly redeeming preference share now, a preference share is a form of equity. So by legal description, you know, it's an equity. By legal, form, it's an equity. But in terms of substance, it is a liability. Why do you call it a liability? You remember that the word redeemable stands out in this. When you say something is redeemable, redeemable, it means that the issuer has the obligation to redeem, you know, that value, for an amount at a fixed future date. So since there is an obligation to do what? To redeem, to pay, to pay that loan back or whatever, to redeem that share, then you simply say that the substance of that transaction now is what will actually hold in this instance, not necessarily the legal form. And there are other examples like that. You talk about irredeemable preference shares, for instance. Irredeemable preference share, the issuer has no obligation to redeem for an amount at a fixed future date. But notwithstanding, remember that we said that it is cumulative. Cumulative means that if they don't make profit now, if they make profit later, the shareholders have a right to claim the dividend for the current year that they have no profit. So that means if the company says, "Oh, we don't have profit for 2, 3, 4 years," in as much as it is cumulative, their dividend is cumulative. They are going to, claim the dividend for those previous years that they had no profit. So by virtue of that, you simply say that in this case now, even though the preference share stock is an equity, but in terms of the substance, because the issuer has obligation to pay something back, whether in form of dividend or anything, whether at the moment or at future date, by virtue of that, the legal form will not hold in this instance. It is the substance of that transaction. And so therefore, it will be regarded not as equity, but it will be regarded simply as what? As financial liabilities. And that is the general rule. That is the general classification that we know. But however, there are certain financial instruments that need further explanation, whether they should be classified as liabilities or they should be classified as equity. Certain financial instruments that you cannot just say this one is obeying the rule. It's a financial liability. It's a financial liability or it's equity. There are certain things we need to explain about them, and I think I have about 4 of them here. Number one is contingent settlement provision. Then you have the settlement option. You have compound financial instruments, and then um, you have treasury shares. So the first one, which is contingent settlement provision. Now when we say contingent, when transactions there are transactions that depend on the occurrence. They depend on the occurrence or non-occurrence of certain events, and those events are not even uncertain events. So the occurrence or not occurrence of those transactions depend on certain will I say certain depend on some uncertain future events. So therefore, where an entity have to deliver cash, instead of using equity or equity shares, but such decisions is beyond the control of the issuer and the holder of the instrument. In that situation, you classify that instrument as what? As uh, as uh, as um, as liabilities. You classify it as liabilities. I want to come again. Contingent. When you say contingent liability, you know what that means. That for you to incur that liability, it depends on whether a particular future event happens. Take for instance, the general one that we used to know is a lawsuit. So say lawsuit that at the beginning of the year or by the middle of the year, you estimate that you are going to incur some court case and you're going to spend certain amount to take care of that. So you estimate 20 million. Then at the end of the year, when the case actually came up and then you went to court and all that happened, then you realize that you didn't spend up to that. So you are not certain about what that liability will be, or you're only making a kind of provision for it. So that kind of provision, for instance, now, as it affects financial instruments, is going to be classified as liabilities, unless there is a possibility of settlement. The possibility of settlement is in remote. So that means the possibility of settling that thing in the immediate future is not certain. So meaning that it can take years. So in that instance, you may not necessarily have to say you are classifying it as liability. But the simple rule is that according to IS 32, that in as much as there is a possibility of settlement in the immediate, in the nearest future, then it's a liability. But when there is no possibility of settlement in the nearest time, you may not necessarily have to follow that. So that is that. Then number two, we talk about settlement option. Settlement option. Simply, when a derivative, for instance, you talk about derivatives, when a derivative financial instrument gives one party a choice, once you have a choice over how you want to be settled or how you want it to be settled, you know, whether through cash or through issue of shares, then you classify that as a financial asset or financial liability. The only conditions or the only thing that will make you to classify it as equity instrument is when all alternative choice will result in that. So that simply means that if you have a choice as to whether you want to be settled by cash or by issue of shares in this particular transaction now, then that choice that you have makes it that the classification of that settlement should be regarded as a financial asset or as a financial liabilities, unless all the alternative choices will result in it being an equity instrument. So in as much as all other alternatives will not result it in being regarded as an equity instrument, then settlement option is taken as a financial asset or financial liability depending on the nature of the transaction anyway. So that is settlement option. Then number three, we have compound financial instruments. Compound financial instruments. There are certain instruments that they have both liabilities and equity elements. They have both liabilities and equity elements. For instance, a convertible debt. A convertible debt, for instance, creates a primary financial liability of the issuer and grants option for the holder of that instrument to do what? To convert it into an equity instrument. That's ordinary share capital of the issuer. So as far as the holder is concerned, the holder can decide to convert that thing into a what? Into ordinary share of the company, instead of still regarding it as a debt. So that means that thing has a what do you call it now, a an element of debt and also an element of what? Equity instrument, depending on whether the holder is going to um you know do the convert, take that alternative of converting it to shares. So that is why we have that, and we said that this is actually recorded like that in your statement of financial position. So you split it into equity and liability components and present it accordingly in the statement of financial position. So just what you have here, you have the instrument as a whole, you have the value of the liability, you deduct it from that, then you have your residual value of equity. And that's what we said in video one, that equity instrument evidences a residual interest in the asset of an entity after you have deducted all its liability. So you can imagine the instrument as a whole, the value of liability deducted from it, then the balance gives your residual value of equity. That's equity instrument. So we'll be taking a question on that as I progress. Then number four types of instrument that also require some explanation is treasury shares. Treasury shares. Treasury shares. And naturally you deduct when we say treasury shares, that means you are buying back your own equity instrument. So the rule is that you deduct it from equity. And we should also take note that consideration paid or received, will be recognized directly in your equity, and there won't be any gain or loss, on that, because it's your instrument. You are buying it back, so there won't be gain or loss recognized in your profit and loss on the purchase, on the sale, on the issue or cancellation of what, of an entity's own equity instrument. So that is just the simple um, treatment for all that. And we progress by also saying that, remember we said that the standard uh, tells us how to present financial instrument as either equity or as liability. Then the second part that the standard tries to clarify is that it does not permit offsetting between financial assets and liability. You know what offsetting means, so that's very straightforward. You have a, you know, you are using them to offset, each other, and the net amount is reported in the statement of financial position. So it does not permit offsetting between financial assets and what, and financial liability, except the entity has a legally enforceable right to do so, and except it also intends to settle on a net basis or to realize the asset and settle the liability simultaneously. Those are the only conditions that will warrant that you offset. Um, that's that. So we'll take a question, and the question we are taking is basically on that number 3, which is compound uh, uh, financial uh, instruments, those that have elements of financial liabilities, and also have um, element of equity in them. Now let's look at this question. Let's look at this question on compound financial instrument. They say Unilag Co. issues 2,000 convertible bonds at the start of 2002. The bond have a 3-year term and are issued at par with a face value of 1,000 naira per bond, giving a total proceeds of 2 million. Interest is payable annually in arrears at a nominal amount interest rate of 6%. Each bond is convertible at any time up to maturity into 250 common shares. When the bonds are issued, the prevailing market interest rate for similar debt conversion option is 9%. At the issue date, the market price of one common share is 3 naira. The dividend expected over the 3-year term of the bond amount to 14 kobo per share at the end of each year. Using a discount rate of 9%, the present value of 1 naira payable at the end of the 3 years is 0.772 naira. The cumulative present value of 1 naira paid annually in arrears for the 3 years is 2.531. Require, what is the value of the equity component in the bond? The value of the equity component in the bond. Now you need not to stress yourself. Now let me quickly show you again what we are interested in. We are simply interested in the residual value of the equity. That's what the question requires. And all you need to do is to determine the instrument as a whole, the value of the instrument. And the value of the instrument is right there. All you need to do is to try to determine the present value of them. That's why we're given those figures, those rates there. And then you determine the value of the liability component of it, and then you have the balance as your what, as your uh, as your equity. So coming to that question, all you need, number one, you need your um you need your, yes, convertible loan bonds, and then they said at 1,000 naira per bond, and that gives a total proceeds of 2 million. Total proceeds of 2 million. Then they said interest is payable annually in arrears. Now take note, when they say interest is payable annually in arrears, you remember that your interest paid in arrears simply means that it is paid at the end of each year. It is paid at the end of each year. So that means if you have in year one now, starting in January, then by 31st December, the interest will be paid. And and on like that, and it's going to be for 3 years, and the rate of interest is 6%. The rate of interest is 6%. So you need this 2 million, then you need this 6%. Take note of that. Don't bother yourself with, they said the bond, each bond is convertible at any time. So that's just the keyword there, but we don't need these 250 bonds here, 250 common shares. Then they said when the bonds are issued, the prevailing market interest rate for similar debt without conversion option is what? Is 9%. That is the market rate, the market rate. That is what we are going to use to determine the present value of that interest. And they said at the issue date, the market price of one common, you don't need that one again. Then they said using a discount rate of 9%, the present value of 1 naira payable at the end of 3 years is what? Is 0.772, and the cumulative present value of 1 naira annually in arrears for the 3 years is 2.51. So looking at the solution now, number one, determine the value of the liability component and subtract the proceeds of the bond to arrive at the equity. That's what we have in that format above there. Then after that, you determine the present value of the liability component, which is the principal, and this is calculated using a discount rate of 9%, which is the market rate for similar bond. The market rate for similar bond. Now take note of this: 1 divided by 1 plus R. 1 divided by 1 plus R. The R is your interest rate, and then your N. You are using that to determine the cash flow. I want to explain to you how they arrive at those cash flow. So all we need to do, then let's quickly calculate the present value of our interest. Remember that the proceed is 2 million and the interest rate per year is 6%. So that means the present value of the interest for each year is what? Is 120,000 naira. 120,000. So that's the interest that you're going to be paying each year. So now let's determine the value, the present value of the principal payable at the end of 3 years. Payable at the end of the 3 years, that's going to be, the principal is 2 million multiplied by 0.772. How did we get 0.772? They said using a discount rate of 9%, the present value of 1 naira payable at the end of 3 years is what? 0.772. So that means that 2 million that will be paid at the end of 3 years, the value of it as at now, right now, the present value of that amount is 1,544,000. So 2 million, the proceeds multiplied by what? By that present value rate, which is this one, at the end of 3 years, 0.772. So you have that as the present value of your what? Of your equity, of your, sorry, of the principal, of the principal. Then you now talk about the present value of the interest payable annually in arrears for 3 years. Don't forget the principal, the interest rates, the interest per year is 120,000, and then they said for 3 years they have been able to determine the cash flow for 3 years, the cash flow CF, DCF, using your DCF, this formula. So for 3 years, for year one, for year two, for year three, put together gave 2.531. And if you like, you can do it one after the other. Take for instance, you have this formula: 1 divided by 1 plus R power n. R is the rate of interest, which is 9. So you have 1 divided by 1 plus 0.09, that's 9%. Then power n, you do that for year one. Then for year two, 1 divided by 1 plus R, that's R, there is the interest rate again, 0. What? 0.9 all over what? All over 2 for year 2. You do the same thing for year 3, 1 divided by 1 plus R, which is 0.09 divided by all over what? power n, which is your 3. That's the third year. So they've been able to do it to give us a single figure for the 3 years instead of stressing yourself to do for each year. So you have the cumulative figure here as 2.531. They said that the cumulative PV of 1 naira paid annually in arrears for 3 years is 2.531. So you multiply that 2.531, use that to multiply the interest rate. That's giving you 3.302720,000. That gives you the value of the total liability. So the liability now is basically your principal plus your interest. Principal is 1.544, while interest is 3.03720,000. By the time you add the two together, you have the total liability component. And then the proceeds of the share is 2 million. The proceeds. So when you deduct the proceed, which is the total value of the asset, you subtract your total liability from it. You have the balancing figure here. Is a balancing figure. That's 2 million minus 1,847,720. That gives you 152,280, and that is simply your equity component. And that's what they ask us to determine here. That's what we have here in this format. The instrument as a whole, that's the sales proceeds that we have in that question. The value of the liability. The value of the liability is both the principal plus the interest. When you subtract that, you have the residual value as your balancing figure, and that is what that question actually requires from us. So take your time to lay hands on other examples, similar examples. It's still the same principle. So, and I'm sure you have done all of this most likely in your finance and all that. How to all those things you must have done that. So, as I close this topic, I will be adding. I will be attaching the material still on this topic. Apart from this video, when does debt seem to be equity? That's all that we have discussed today. When does debt seem to be equity? So when do you classify an instrument now as debt or as equity, and when does debt seem to look like it's an equity? Don't forget, it's a very straightforward thing. So I think it's about 4 pages material. So take your time to go through it. Don't say I didn't tell you, okay? Don't say I didn't tell you. That can just be a simple question. When does debt seem to be equity? So take note of that. So apart from the classification of financial instruments as liabilities or equity, the next remaining or emanating issue under this topic is the recognition of financial instruments. So we have been able to deal with the issue of classification of financial instruments as either a liability or as equity. So after now, we'll be moving ahead to topic focusing on the recognition of financial instruments. That is when to recognize or de-recognize financial assets or liabilities. So when do you recognize it? When do you include it in your financial statement? And when do you de-recognize? Simply means when do you remove it from your financial statement. So we'll be looking at that in the next class, the next video, the next material as time will permit. So that is the next focus. So go and read on it. Recognition of financial instruments. Till I come your way next time, stay safe and remain happy. Bye bye.